Mitesh Daga of TPG joining in to discuss this. Mitesh, thank you very much for joining in. 4 billion this year. What do you expect next year?
Thank you, Ekta. That was a very, very comprehensive summary. Well done. You are right. I think the activity levels were incredibly high this year. The awareness towards the need for more healthcare capacity being built in the country is increasing. And there is almost about $200 billion of capital that is required to bridge the demand-supply gap that exists in quality healthcare supply today. So private equity is playing an important role to bridge that gap, and we will see more and more private equity participation in the hospital sector. But I think, like you alluded, we might see lower deal activity next year than this year, because most of the larger chains have traded recently, and there will be some gestation period, like you mentioned.
But Ekta did allude to, a lot of PE firms looking at the hospital space in India, so many deals happening. With the kind of demand that there is for all these hospital assets, etc., do you think that structurally valuations are likely to increase over and above the multiples that she spoke about? And what differs you from all the others who are chasing assets in the same space?
Great question. Valuations, many people can't make, including us, we scratch our heads on the valuations for the sector, but it's true across the board for India, right? Indian public market valuations have always been higher than the emerging markets. So, and there's a reason for that. I think one is the long-term secular growth tailwind, and second is the high ROEs that India generates. The secular growth tailwind that we see in the hospital sector in India will, I think, command attractive valuations for operators who can operate efficiently and generate the right margins and ROC.
Okay, well, Mitesh, one of the things that stood out is a lot of these regional hospitals getting a lot of funding, even specialty hospitals. We've spoken about, IVF, eye care, Punjab-based hospitals. There seems to be one singular focus. Is that going to be a trend which we'll see next year as well?
Yeah, so Ekta, we have a very, very fragmented hospital provider base in India. If you add up the top 8 hospital chains in the country, they own 5% of the bed capacity in the country. There's 95% which is very fragmented across thousands of hospitals. So that presents itself for a consolidation opportunity, and given that the large chains have got traded now, you will see regional platforms becoming attractive for private equity, and you will see single hospitals folding up into regional platforms, and eventually regional platforms folding up into the national chains. And that's how consolidation will happen in the country.
Okay, well, go ahead, Mangalam.
Well, we'll take a short break, come back, and we'll continue our conversation with Mitesh. An interesting conversation lined up for you after this short break.
Welcome back. Well, we are still in conversation with Mitesh Daga, who is a partner at TPG Capital. He is talking to us about the healthcare space. Well, Mitesh, one of the things that stood out is that there's been a majority amount of investment which have come into the hospital space, not really in healthcare technology or other segments in 2023, maybe even diagnostics. Why is that?
So number one reason is there's a largest need for capital in the hospital space. India is now maybe a $370 billion healthcare market, and large part, 60 to 70% of that is hospitals. And like I mentioned earlier, there is about $200 billion needed to build more capacity to bridge the demand-supply gap.
Right.
So it is the largest segment, and hence you will see more money coming into that segment. The other large segment is diagnostics. Not too many large-scale providers over there, and plus valuations have been quite rich over there for a period of time. So that hasn't attracted too much capital of late. But then single specialty providers are also seeing interest from private equity funds like us.
You did say that while we were talking in the break, that there is a lot of capex coming into the hospital space. A lot of companies have announced their expansions, etc. as well. Do you think the gestation period for investors would increase given these capacities will now come on stream, and only then will these hospitals start to sweat those assets?
Absolutely. So I think last 5 years was a phase of consolidation where hospitals were burdened with debt on their balance sheet, and they were optimizing the assets that were built 5 to 10 years back. Most of those assets are optimized today. So if you look at the large hospital chains, they're all operating close to 70% or plus occupancy rates. And hence they've all announced major capex plans over the next 5 years. So Max has announced about adding 2,500 beds on a 3,500 capacity. Apollo has announced similar numbers. So, and with new capex, the gestation period for just the payback on that capex is about 7 to 8 years.
Right.
So, which means you will now have to be more patient and hold longer to get the returns on the investment.
Okay. Well, one of the things, Mitesh, and I'm veering away from the entire investment point of view, is the fact that medical inflation is in double digits. It's around 14%. When a PE fund comes into a hospital, what are the changes that take place and how do you deal with that medical inflation, especially for people who still are not within that insurance basket?
Great question. So medical inflation is a combination of case mix and more complex work being done, which is good news because we're building those capabilities and we're able to save patients who are at late stage or more complex stage of disease burden. But it's also coming from price inflation, right? So when someone like us comes in, we look for efficiencies in the business. How do we drive cost efficiencies which can then be passed on to the patients and the customers? This could be on the procurement side. So with scale, you can get better deals from your vendors, pharma companies, companies selling you medical equipment, consumables. Also by consolidating what you're using in the hospital. So working with doctors to consolidate the number of brands and the formulary that we have, which again then we can negotiate a better deal with the pharma companies. So at Manipal, for instance, we have been able to do that very successfully over the last 8 years and driven margins up without taking any price increase or rather taking price increase at much below inflation rates. And we passed on all of that benefit to the patients.
A lot of the cost synergies brought in by PEs. What on revenue front do you all do differently?
So building centers of excellence, building the depth in terms of clinical capability is important, and providing that platform to the doctors. So building the right infrastructure, bringing in world-class infrastructure, bringing in capabilities or partnerships from global institutions helps us build these centers of excellence, which drives revenue. Apart from that, it's a payer mix, as you will see in the case of Max last 2-3 years. The amount of patient or percentage of revenue that they're getting from insurance has doubled, which is driving more revenues as well.
Anything that you're buying in the next 1 year or selling in the next 1 year?
Nothing that I can share right now.
I'll put you on the spot out there.
All right, Mitesh. Thanks very much for joining in, taking out the time. And well, we'll definitely see you next year and have a great new year. Wish you a great Christmas as well and festive season. Well, on that note, it's a wrap on Halftime Report. Stay tuned. Business Lunch up next.